Hi, good evening, everyone. Welcome to Master's Teach. And today we are going to discuss accounting for managers. It is a first sem uh, MBA, and it is will be a live session. I'm going to discuss entire 5 units, which will be useful for your exam. So, let us discuss accounting and economic decisions. Okay, we'll discuss about the role of accounting for managerial decisions and making business planning and control. Okay, so let us see about this particular chapter. Okay, role of accounting in management. Okay, one is uh, planning, another one is control, third one is decision making. As a manager, the account is going to help you how to make the plans and how to make the budget and for the coming operation, future operations. And also every day we can see the performance of the company in the way of numbers, and we can also take the corrective measures. And also decision making, that means so it providing the financial data for strategic business choices. Okay, these are the things like the process of accounting, how it happens. In examination they may ask process of transaction, how it's happen. First is a source of document, second one is recording, third one is double entry, and fourth one is a financial reports. So source of document, in order to make the any accounting, first you need to have source of accounts. That may be invoices, like purchase, sales, receipts, vouchers. Okay, it gives the evidence as well as it gives the accurate information. That is a source of document. And once you get these documents, you are going to record the same, like meaning you are going to prepare journal entry, you're going to prepare trial balance, you're going to prepare uh, profit and loss account and balance sheet. So these are the recording steps. Okay, first is source of document, invoices, receipts, vouchers, and providing transactions and evidence. Then recording means identify, analyzing, and recording the post transaction systematically. So how the accounting um, makes complete cycle. Okay, this is the thing how it can be done through journal entry. Okay, so like we are going to record the journal entries in chronological order, then ledger, then trial balance, then financial statements. These are the financial statements includes the trading account, profit and loss account, and balance sheet. Okay, here first the complete account transaction you have to write journals, ledgers, trial balance, and financial statement. You're all aware, those who are already done their BCom or BBA in your undergraduate level. So this is the thing. Then journal entry. How the journal entries happens here? Okay, one is for example 1st January. So the cash is debited 50,000 to capital account. Okay, in order to purchase the capital account. So debit 50,000 and credit what? Capital account. Being capital introduced. So debit what comes in, credit what goes out. Here the what is went out amount, what is coming, it is the capital. So the same thing we mention here to capital account, 50,000. Okay, this is the cash account, this is the journal entry format. Okay, you're always already aware about the golden rules of the accounting. Okay, so trial balance, how the trial balance is prepared. Example, we purchase the capital, so cash is 50,000, capital is 50,000. Okay, then purchase and sales, so total is 80, 80 is tal. So what is the objective of trial balance? It is verify arithmetical accuracy of ledger account. So what is the common errors? So errors of omission, errors of commission, then compensating errors, and errors of principles. I hope you are able to recollect the same. Okay, then See, this is a uh, only 30 minutes. I'm going to cover all your first semester accounting for managers. So accounting for merchandising transaction, what we does, one is purchase entry and sales entry and the discounts. So purchase transaction will be entered in the cash and credit purchase with the trade account, recording the net amount. Then sales transaction, we record the same revenue recognition for cash and credit sales for applicable discounts. And discount, trade discount, it is a reduced list price, whereas cash, we give the early payment incentives. So these are the things. Okay, trade discount, cash discount. uh, it is a trade discount comes in reduced list price, whereas cash discount when we give the early payment. That is the thing. Okay, here, periodic versus perpetual inventory. So there are two types of inventory. One is periodic and perpetual inventory. Periodic means physically count at the period ending, whereas perpetual, it is a continuous and real time tracking. So the difference between perpetual and periodic. Okay, so recording end of the period and continuous cost, lower cost in the periodic, whereas perpetual is higher accuracy, less accuracy in periodic, whereas perpetual continuously same day, it is a more accurate. See, for the like for periodic, it is a small business, whereas perpetual is a large businesses. So uh, perpetual system provides a real time inventory where data for the better decision making. Okay, then internal control and internal control system, one is a cash control and receivable controls. Like here it is there that segregation of duties, daily cash reconciliation, bank reconciliation statement, and petty cash impress system. These are the cash control, whereas receivable controls, credit approval procedure, aging analysis of debtors, then a regular follow up on overdue account, provision for doubtful debts. So this is the thing. Then accounting concept and convention. Okay, one is here, business entity separate, like business is separate from the owner. Then it is concerned about the business continuity indefinitely. Then money measurement, only monetary transactions are recorded. Cost concept, assets recorded historical cost, matching revenues with the expenses. Conservation, anticipate losses, not profits. So what you have to write in the exam, they may ask, explain the accounting cycle of with a flow chart. That time you have to explain this. Okay, accounting transaction for the flow chart, you have to mention. Okay, journal, ledger, trial balance, and financial statement, that you have to make the same. Or else you can also do the same. First, source of entry, document, source of documents, recording, double entry, then financial report. Or simply you can write this the complete accounting cycle: journals, ledger, trial balance, and financial statement or final accounts. These are the things. Then it comes to the, what is going to ask here. Let me check. So distinguish between periodic and perpetual inventory system. So periodic is end of the thing, and whereas perpetual is a real time. Journal entries for merchandising transaction with the discounts, we already discussed in this particular thing. Okay, so explain the accounting concept with the example, so you have to write all those stuff. So we'll check the next slide. Okay, kindly be online. Okay, the next slide, the next slide, be online. I'm going to open the same. Okay, this is the second unit. Here the second unit consists of accounting for inventories. Okay, accounting for inventories. Okay, I hope you're able to see the same. Accounting for inventories. Yes, kindly be online. Accounting for inventories, because we need to cover at least 5 units in this particular thing. Okay, this is the accounting for inventories, where we are going to study comprehensive guide to inventory valuation methods. So manufacturing cost accounting for management for students. Okay, in this, let me check. Yeah, I'm going slowly. Okay. So, like types of inventory. So, what is inventory? Inventory means asset held for sale in the ordinary course businesses, in the process of production, or in the form of material consumed in a production or rendering services. Okay. So, why it is important? We come to know the what is correct current assets. We are able to like directly what is the impact of working capital. So we are also examining the critical financial statement accuracy. So types of inventory. One is raw material. So material awaiting for use in production, whereas work in progress. The materials are raw material. See, the inventories are three types. One is raw material, work in progress, and finished goods. Raw material means before going for the production, whatever the material is ready, that is called raw material. And work in progress. There's a like part of the raw material used, okay, whereas finished complete products ready for sale. These are the three types of inventories: raw materials, work in progress, and finished goods. Then inventory valuation framework. So the objective is to get the exact profit determination, whereas we are going to get the true financial position, then compliance with the standards. So valuation rule is lower cost or net reliable values, cost equal to purchase plus conversion plus other cost. Okay. Impact of the statement, statements, we are going to have the current assets, as well as we are going to have the in profit and loss account, we are going to have cost of goods sold. So this also affects the gross profit margin. Okay. Then components of inventory. What is the inventory components? One is purchase cost, conversion cost, then other directly attributable. So all direct costs including bringing the inventory to its prevent location and present location, and condition must be includes the valuation. So the components of inventory cost includes purchase cost, conversion cost, and other cost. Purchase cost including purchase price, then import duties, non-refundable taxes, and transport cost. There are almost four things happen. One is purchase price. What is the purchase price? And if it is imported from other countries, import duties price, then non-refundable taxes, then transport cost. These are comes under purchase cost, whereas conversion cost. So direct labor with overheads like fixed and variable incurred transforming raw material into finished goods. When the material is processed from raw material to finished goods, whatever the overheads happen, that is called as conversion cost. Whereas other cost, any other cost including the inventory current state and location, such as design cost for specific products, or necessary storage cost during the production process. These are the other costs apart from purchase cost and conversion costs. These called as other cost. So here, then we go to specific identification method. So each inventory item is tracked individually with the special actual cost ideal when items are not ordinarily or inchargeable. So advantage of specific identification method is accurate cost matching, precise profit calculation suitable for unique items. What is the limitation? So impractical for large volumes, high administrative cost, and requires detailed track. Just go through this one. So those who are already purchased app, they can download this particular uh, PPTs that will be useful to you. Then there are how the this FIFO LIFO inventory wise. What is FIFO? First in first out method. Items purchased first are sold first. So close stocks valued in at most recent cost. So whatever the purchase first is purchased, then it will be sold in first out. Okay. Here the example is that higher closing cost value, higher profits match the physical flow in business. So what happens? So the cost of the stock may be higher, as well as they can easy to maintain the inventory. For example, here 1st January 100 units purchased at 10 rupees, and 15th January 150 units purchased at 12. So total how many we purchase, like 100 plus 150, okay, 250, in which we sales 180 units at the 70 rupees at 12 cost. So closing stock is 70 units into 12, so 840. So this is the thing about the first in first out method. And last in first out, what does that mean? So whatever the recently purchased, that item need to be sold first, so closing stock valued at earlier cost. So what happens, lower closing stock value, higher COG, lower profits, and better tax planning not permitted under accounting standards. So numerical example here, okay, just go through this, okay. Here the thing is, LIFO is prohibited under IAS 2 as well as IND-AS 2. So not allowed under US GAAP. Okay. So this is about the lost in first out. So whatever the purchased recently, that has to be sold first. Okay. This is a lost in first out LIFO method. Then weightage average method. So it is the average different purchase prices regardless of quantity. Formula: sum of the prices divided by number of purchases. So this is the formula. So weightage average considers both price as well as quantity purchased. The formula of the weightage average is total cost divided by total units. So numerical example here given here, just go through that one, okay. Then comparison between valuation method here: LIFO method, FIFO method, LIFO method, and weightage average method, okay. Here it is given, just go through this one, okay. So manufacturing cost and costing methods. So the like direct method, direct material, direct labor, prime cost, total management, manufacturing cost. So cost components include, what is the cost components include? Direct material, that is a raw material and direct traceable. Direct labors, wages of production workers. Manufacturing overheads, so indirect factories cost, etc. What is the prime cost? So direct material plus direct labor. What is conversion cost? So direct labor plus manufacturing overhead. So direct versus absorbing cost here, okay. Just go through this one, okay. As well as you can check the in our app also, where you are going to have this PPT. So this is about the second unit. Then uh, we'll go to third one. Kindly be online. I'll open the third unit, okay, so that you're going to have clear picture about this accounting for managers, okay. So here we are going to discuss accounting for fixed assets, how the accounting can be done for the fixed assets, okay. Let me share the picture, okay. Inventories is over, then we are checking for the fixed assets, okay. Be online. I'll share the same. If you are newly watching, do subscribe and share with your friends, okay. uh, like yeah, yeah, I'm sharing other thing, okay. It is like accounting for fixed assets, okay. It is for like fixed assets, what the like long term holdings, okay. Whereas the characteristics of fixed assets, it's a long term use. It can be used over and over, many years, like not meant for resale. For example, you purchase the machinery and you purchase the building and land, that will be fixed. You're not it is not meant for to resale. Then physical existence is there, where the operation, the manufacturing can be done. Then subject to depreciation, for example depreciation for machinery and all the stuff will be there. These are the key characteristics. So fixed versus current asset. Fixed assets is a long term holding, you can keep for number of years, whereas short term assets is for only for under 1 year, where fixed asset not easily convertible. then current asset can easily sold. Okay, so example, you can write the building machinery, whereas current assets you can write the cash and inventory. Depreciation over a time, the fixed asset get the depreciation, whereas current assets don't have depreciation. Okay, getting my point. Then we'll check the next. Okay, we'll go to the next slide. Okay, determination of cost acquisition, how the fixed asset can be the cost of fixed asset can be calculated. One is purchase price. What is purchase price? Invoice amount less trading discount. Then it include the installation cost of the machinery, like labor cost, material cost, testing expenses, etc. Then freight and taxes, so including transportation, non-refundable duties, etc. Additional cost also included, site preparation, legal fees, etc. These are the determination of the cost of acquisition. So the formula, uh, this one, cost of asset equal to purchase price plus freight charges. Then here, installation charges plus a site preparation minus trade discount. These are called as cap cost of assets. Just remember the same. Then accounting for depreciation. So some of the machineries, like, they will get depreciated, the value will be decreased. So why depreciate? So match expenses with the revenue, so it shows the true asset value. Then as per the accounting standard, the depreciation has to be maintained. So in order to replace asset, we make the asset depreciate. Okay, so why it is happen? Due to by using the car or maybe machinery, you'll get some damage, wear and tear. Then obsolescence, after some time it is going to be, the technology going to outdated. Sometimes the time is experimentation. So these are the things. Objective is that why we make the accounting of depreciation, to get the accurate profit calculation, proper asset valuation, and tax compliance through systematic cost allocation. So the different methods of depreciation. Straight line method, so depreciation equal to cost minus scrap value by useful life. Example, machinery cost is 1 lakh, scrap value is 10,000, life is 5 years. So that means appreciation is annual appreciation is equal to 1 lakh minus 10,000 divided by 5 years, it comes to 18,000. So this is called depreciation, straight line depreciation. That means the depreciation will be same for the entire year. The machinery you keeps 5 years means 5 years, entire time it will be 5 years, 18,000, 18,000, 18,000. So accumulated, so this will be plus 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 up to 90,000. The book value become reduced, 1 lakh become 82,000, then 64, then 46,000, then 28,000, then 10,000. So this is the way how the straight line method. If they asked in the straight line, just keep this example: a depreciation equal to cost plus scrap value by useful life. Okay, this scrap value here, they will give the scrap value, they will give the life also, they will give the cost of machine, so that you can prepare this straight line method. These are all there in your become standard, as well as it is there in 11th 12th standard. Okay, written down value method. Okay, so the depreciation equal to book value plus rate, percentage rate. So this is a formula. So numerical example here: 1 lakh, rate of depreciation is 20%. So first year they are going to deduct 20%. After that, then again they are going to deduct 20%, like that they are going to deduct. So WDV, okay, there's the written down value. Okay, charges higher depreciation in early ages. In the starting it will be higher, then it become slow. Okay, while a straight line method, the uniform depreciation will be there. For example, 18,000, 18,000, 18,000. Whereas return down value become in the percentage, book value into rate of percentage, that is a depreciation value. Where here you can r equal to 1 minus a n square s by c. So whereas r for rate, n for life of that machinery, whereas S for scrap, C for cost. So you have to remember this written down value method. Okay, this is a written down. The straight line value is the same. That means 18,000 means every time. Whereas written down value is coming down line here. Okay, this is mentioned here. Okay, so revaluation of the assets. What is the revaluation? So market value significantly differs from book value. So always the market value may be higher or low, whereas it compared with the book value. So why we required when the company makes, we already discussed in uh, this one business environment where mergers and acquisition happens, that time this revaluation of the asset take place where we can use the depreciation, so compliance with the fair value accounting system. So the journal entries accounting, asset account debited to revaluation account, so being increase in asset value. So this will be impact on the, it won't affect on the um, profit and loss account directly. Okay, this remains. What is the, this many times they asked, what is the difference between capital versus revenue expenditure? So capital expenditure means when you are purchasing land, when you are purchasing fixed assets like machinery. Okay, so here it is mentioned capital expenditure means long term, for the long term benefit we do, so it increases the asset value. Then example, purchasing machinery, it is a long term capital, we won't purchase every day. Whereas building extension, if the building constructed, then if you are extending that one, there's the building extension. Then major overhauls, that means major repairs, that also calls under, comes under capital expenditure. Whereas revenue expenditure, it is a short term benefit, for example maintaining the operations, example repair, salaries, so or routine maintenance of the things we make the expenditure, that is called as revenue expenditure. So the critical rule here, capital expenditure appears in balance sheet, whereas revenue expenditure charged in the profit and loss account immediately. So both the things, capital expenditure always appears in balance sheet, whereas revenue expenditure in the uh, profit and loss account. Do remember. So what we have learned is the straight line method, then written down method, then SOYD calculation, etc. Then capitalization rule we discussed. We also comparison different depreciation. Then we discussed about the capital versus revenue things. So try to calculate different methods of depreciation. Also prepare the asset disposal account. So you have to write at least 10 capital and revenue expenditure items. Okay, so general entries, try to go through any like standard books, and you try to fill all the answers that will be helpful to you. Then I'll go to the next one. Okay, kindly be online. Next one, next one, here I am stopping here, just wait. Whereas uh, just wait. Okay, here the, we discussed third unit, we'll go to fourth unit now. Okay, I hope third unit is over. Fixed accounting for fixed assets. Then we'll go to the fourth unit. Okay, I have to open different PPTs because the live class kindly online. And like when you're writing the exam, try to write all the, attempt all the questions so that you are going to yield good marks. The fourth one, we are going to discuss preparation of financial statement. Okay, so we are supposed to use the blackboard and all those stuff. Okay, for the due to time constraint and all those stuff, I'm using this PPT. Okay, kindly understand the same. Okay, here it is coming slowly. Preparation of financial statement, it is a fourth unit of your accounting like accounting for managers. Just let me share this. Okay, um, here, accounting for managers. Okay, this is the thing we'll discuss. Preparation of financial account, how the financial statements are prepared. Okay, if you're already done become and all the stuff, then it will be easy for you. So we have to use the fundamentals, okay, how the things can be done. Okay, here, okay, what is a financial statement? It is a structure report. We know through financial reports we come to know the financial position of the company. We come to know performance of the company. What is the cash flow of an company during the specific period? We come to know. Objective is that uh, in order to have the reliable information for decision making. So who is going to use this particular financial statement? Financial statements, trading account, profit and loss account, and it also like assets and liabilities. Okay, balance sheet. Okay, who is going? Investors or creditors, management, banks, regulators, SEBI, something like that. So those who are in the company also, they want to see the financial healthiness. So that is the reason they are going to read the financial statement. What is the importance? Is that so the performance can be evaluated, examined, and next time what they are going to do, that will be uh, uh, done through this particular financial statements. Okay, so objective already I discussed. Then we'll go to the next slide here. Okay, see, profit and loss account. So you're already aware, profit and loss account summarize the revenues earned and expenses incurred during an accounting period, revealing the net profit or net loss. In order to know the net loss, net profit, what is the revenue, expenditure incurred, okay, that it is done through this revenue recognition. Sales, what is the how much sales, service income, and other operating revenue. Cost classification, direct cost as well as indirect expenses, operating expenses. Then cost, profit calculation. So what is the full form, what is the formula? Gross profit equal to revenue minus uh, direct cost, whereas net profit equal to gross profit minus operating expenses. Just you have to write all those things. Then this is the vertical format of vertical means straight. Okay, sometimes horizontal also can be done. So most of the time vertical. So vertical happen, you have to mention here particulars. Okay, whereas gross profit, where you are going to deduct the less operating expenses and less depreciation, we will get the operating profit. Then again you have to deduct less interest, then profit before tax, then you have to interest deduct the tax. So this is the thing. Okay, this just if you write this type of format also, just make sure that you have to make the all boxes. Okay, vertical account, or else horizontal also you can make debit and credit particular, like that you have to mention. So what is the key adjustment you have to mention here in profit and loss account? Outstanding expenses and prepaid expenses deduct from expenses, depreciation of the assets also in debit side, then provision for debts and closing stock adjustment can be done this profit and loss account. Whereas balance sheet has two sides. It says about the financial position of the company. Okay, it has two things, assets and liabilities. So assets include the uh, fixed assets, investment, like non-current asset, that means fixed assets and investment. Whereas current assets include cash, inventory, receivable, etc. Whereas liabilities, it's about the share capital, reserves, okay, long term borrowing, current liabilities, etc. Then equation, current assets equal to liabilities plus equity. This fundamental equation must always balance, or equities plus liabilities plus equity equal to asset. That should be a balanced one. This is a balance sheet. This is a called as in order to know the financial position of the company. Then balance sheet format as per schedule 3. First you have to write equity and liabilities. Okay, just shareholders fund, share capital, then reserve for surplus, then non current liabilities. Okay, so this is the current thing. This is a total assets is 9,50,000, whereas it is a total liabilities, sorry, equity and liabilities here, whereas assets is non-current asset and current assets. So 6 lakhs plus 3 lakh 50,000, it comes to the 9 lakh 50,000. This is a balance sheet format. Try to at least make the tables and insert wherever is required, liabilities and asset. Then you'll get some marks. Don't leave anything blank. If you're doing that one, then you're going to lose the marks. So examiner always says whether you fill the examination answer sheet or not, as well as you have to some effort, you have to keep the effort. Okay, and write in with good handwriting, proper tables and proper numbering. Some people are forgets when they are writing the examination, so you have to mention the particular of your question number, answers, etc. Okay, so this is a measuring income. Okay, so here this is the like transaction happens, how it is there, so recording everything. Okay, then complete accounting cycle, how the accounting cycle happens. I hope you are able to see, or else just download my app where you are going to see entire thing. So first we make the journal entries. So okay, then with the proper documentation, it is supported by the primary documentation. Then we go to the ledger. Whatever is mentioned in journal entry, it go to the post ledger. Then after that, from ledger to it go to the trial balance. After trial balance to adjusting entries can be done, okay, in profit and loss account. Then we'd go to the financial statement, like in trial balance, adjusting entries done, then financial statement, we make the profit and loss account, balance sheet with the adjusted trial balance, then closing and transfer revenue and accounting to profit and loss summary, we make the thing. This is the complete cycle of the accounting. Okay. One more thing, as per companies uh, Register of Companies Act, one has to maintain the corporate financial reporting framework, how it is can be done. So annual reports provide the comprehensive financial information to stakeholders, ensuring the transparent regulation. So as per the regulatory thing, uh, one has to maintain the accounts. So the director, managing director, always discuss its the performance and operations of the future outlook. For example, Reliance, they every year they'll in annual general meeting, they gives, we already discussed in business environment. Then auditors reported. So whatever the accounting is done, that is scrutinized and stamped by the auditor report. Then financial statement, profit and loss account, balance sheet, cash flow statement prepared by as per Indian accounting standards. These are the, it's the corporate responsibility to prepare the financial accounts. Okay, so examination point of view, you have to prepare the profit and loss account, trial balance, etc. So you have to difference between like difference between cash basis and actual basis of accounting, and you have to prepare the balance sheet as per the schedule 3. Okay, then describe, you have to write the complete cycle of the flow chart which is given. If you are watching, just revise and take the screenshot of them, that will be helpful to you. Then who are going to report this financial statement in corporate world, that is a managing directors and all the stuff. This is a small presentation. We'll go to next one. Okay, be online. I will share the other one. Okay, be online. I hope I'm taking little more time. Third chapter, fourth chapter is over, only one unit is there. Okay, let me explain this one and share with your friends, those who are watching, those who are preparing. Okay, and that will be helpful to you. Okay, people won't come to management colleges, simply they at home and due to their financial or other obligations. So fifth unit is a financial statement analysis. Okay, financial statement analysis, I'll show. Okay, be online. Okay, uh, financial statement analysis. Okay, here, yeah, financial statement analysis. Okay, this is the fifth unit, financial statement analysis. So we have to analyze the statement in systematic way. It is there in management accounting. So financial statement analyzing the systematic evaluation of company's financial data to access performance, identify trends, then support strategic decision. So in order to make we'll evaluate the like financial statements, so that we can come to know what is the performance of the company, what is the latest trends, and what is going to be taken. So why it is matter? So managers able to make the decisions. Okay. And at the same time, the manager is able to know what is the strength, weakness, okay, opportunities, okay, and what facilities need to be done in order to uh, be benchmark in the according to benchmark of the industry, how we are going to do. So why it is matter? It is for the managers here it is discussed, okay, to make the decision, to know the SWOT analysis, like strength, weakness, opportunities and threats and etc, and also financial performance benchmarking. Okay. So how we are going to analyze the thing? Okay. One is ratio analysis, comparative statement, common statement, and cash flow analysis. So ratio analysis, so we are going to done like quantitative relationship between financial statement, like liquidity, profitability and efficiency. Comparative statement, we are going to compare the last financial, how much profit, and now what is the current year, that we can analyze in trend. And common size statement, so we can make in like percentage, etc. Then we can also analyze how the cash is moving, okay, how the operations is, whether efficiency or not, that we come to know by using the tools and techniques in financial analysis. So objectives of financial statement analysis, then we come to know like assessing profitability, whether the company is working in profitable or not, then we come to know the thing. Then evaluating liquidity, so determine the capacity to meet the short term obligation and maintain operation continuity, whether we are going to continue the business or not. Okay, that is the thing. Measure solvency, so that means they are having the financial debts properly or not. And at the same time, analyze the efficiency, so assets are utilized proper or not, whether it is generating revenue or not, whether the managing properly or not. That can be done through operations of financial statement analysis. So what is the objective of financial statement analysis? You have to write: assessing profitability, evaluating liquidity, measuring solvency, and analyzing efficiency. Okay. So these are the ratios you should remember. Okay. Just it is if you are come to college regularly, we are able to teach everything properly. Okay. People don't have time to come to college. Okay. At least remember liquidity ratios, formulas, and current ratio. Current, the formula is current assets by current liability, that become the ideal for 2 is to 1. Okay. It is the short term measure with current ratio. Quick ratio is current assets minus inventory divided by current liabilities. It should be the 1 is to 1, it should be there. Okay. You are going to get the immediate liquidity without inventory, absolute liquidity. So liquid position, cash position, we come to know the formula is cash plus marketable securities plus current liabilities. So 0 0 mm, 0.5 is to 1. These are the things. So solved example here, you can take the screenshot and you can do the same. Then solvency profit ratios, so where you have to mention the solvency ratio equal. Here the mention is that formula is that total debt plus shareholders equity. It measures the financial leverage risk. Proprietary ratio, so in the formula is like shareholders equity plus total assets. It comes to no, shareholders equity divided by total asset, it gives the proprietary ratio. Then interest coverage, EBIT plus so divided by interest rate, which gives the debt obligation. So these are the profitable ratio. Okay. Formula is it, here it is mentioned. Just go through this one and take the screenshot and write the same. Then turnover ratio, here it is mentioned. Okay. Inventory turnover, data turnover, then working capital turnover. So formula here, cost of goods divided by average inventory, so which gives the efficiency of inventory. Then debtors turnover, So net credit divided by average debtors. Working capital equal net formula is net sales divided by working capital. So these are the things. So these are the something numerical values. Just go through that one. Okay. So funds flow analysis. Okay. So in order to understand how the cash is coming to the organization, what is the position, we come to know here. Particulars increase decrease, current assets increases, then current liability decreases, so net working capital comes here. Okay, the formula is net profit plus non cash expenses is a non operating income. So the key components in fund uh, cash flow is the source, issue of shares, sale of assets, funds from the operation. We'll get the income by issuing of the new shares or selling an assets, sales of assets and operation. Application, purchase of assets. Okay, what are the funds we get? We purchase the assets and we also repay the debentures money. We make that payment. Then net change in working capital. So as a manager, it shows how the funds are generated, how, and that funds is utilized properly or not. You come to know by this funds flow analysis. Okay, then cash flow analysis. Okay, operating activities, so cash from business core activities, receipt from customers, payment to suppliers, etc. We come to know. Then investing activities, whatever we get the funds that is invested, like purchasing or sales of the long term assets, etc. Then financial activity, financing activity, cash from equity, debt or dividend transactions are mentioned here. So the objective of cash flow here, the cash flow analysis reveals the actual liquidity position, helping managers plan for cash requirement as the financial asset behind actual based profit. So what we learned today, we learned about the different formulas, we learned about the funds of cash, and here what is the important question is, calculate, interpret the liquidity ratios, prepare fund flow statement from given data, distinguish between fund flows and cash flows, analyze the company performance using the profitability ratio, prepare cash flow and statement as per the accounting standards. So try to attempt all the mandatory questions. Okay. So that uh, you're going to clear this examination. This particular entire presentation helpful to you to clear your examination, not only for this particular MBA, but also useful for your those who are preparing UGC, NET, and others examination. Thank you. All the best. We'll meet in the next video. Okay. Uh, do share with your friends and like the content. Okay. Thank you. All the best for your coming examination.